Hello everybody, welcome to a Unit 5 lecture. We are going to be going over Chapter 15, a few of the learning objectives. We're going to start with Learning Objective 2, Account for Investments in Debt Securities. How are investments in debt securities accounted for? A company records an investment in debt securities by first recording the purchase of the investment. A company records interest revenue. At the date of maturity, a company records the disposition of the investment. So here it shows an example that SmartTouch Learning has excess cash to invest and pays $100,000 to buy $100,000 face value 9% 5-year Neon Company bonds on July 1st, 2018. SmartTouch Learning plans to hold the bonds until maturity. So to record that transaction, July 1st, you record held to maturity debt investments for $100,000 debit and cash you credit for $100,000, and it's to purchase investment in bonds. Record the interest revenue on December 31st, 2018. SmartTouch Learning receives the first interest payments on the bond investment. So their interest was, you get a debit to cash. They were paid cash, $4,500. It's a debit. It pays out cash, $4,500. Interest revenue, $100,000 times 9% divided by 6/12, $4,500. Received cash interest. Disposition at maturity. When SmartTouch Learning disposes of the bonds at maturity on June 30th, 2023, it will receive the face value of the bonds. Assuming that the last interest payment has been recorded, the entry is a debit to cash of $100,000 and a credit to held to maturity debt investments for $100,000. And this was to dispose of the bonds at maturity. Now to go over learning objective number 3, account for investments in equity securities. How are investments in equity securities accounted for? The accounting for equity securities is based on the percentage of ownership. The cost method is used for ownership which is less than 20%. The equity method is used for ownership which is between 20 and 50%. And consolidations are used for ownership which are greater than 50%. Purchase of equity securities, and here's an example. On March 1st, 2018, SmartTouch Learning acquired 1,000 shares of stock in Yellow Corporation for $26.16 per share. SmartTouch Learning owns less than 20% of Yellow's voting stock. So you take a debit to equity investments at $26.16 per share times 1,000 shares, you get $26,160, and a credit to cash of $26,160. You purchased investment in stock. Dividend revenue. Yellow Corporation declares and pays a cash dividend of 16 cents per share on June 9th, 2018. SmartTouch Learning receives the cash dividend on June 9th. It's a debit to cash of $160. Dividend revenue is figured at 16 cents per share times 1,000 shares. It's a $160 credit. You received a cash dividend. Disposition. On July 15th, 2018, SmartTouch sells 800 shares of Yellow stock for $25,000. So you received $25,000 less the cost of stock disposed of, 800 shares times $26.16. You sold 800 shares. That's $20,928. It was a gain of $4,072. You realized $4,072 profit. So to recognize that, it was on July 15th, 2018, SmartTouch Learning, again, shares, you would sold its shares of stock for $25,000. This is how you would record it: cash debit of $25,000 equity investments, a credit of $20,928, and a gain on the disposal of the investment in the stock of $4,072. Equity securities with significant influence, the equity method. And this is just a table showing significant influence is assumed when a company has 20 to 50% ownership, and it's accounted for using the equity method. With the initial investment, you record the investment at cost. When you receive the dividends, there's an adjustment to the investment account for the balance of the dividends received. With the share of profits, you adjust the investment account for the investor's share of the investee's net income or net loss. So with the purchase, Smart Touch Learning pays $400,000 to purchase 40% of the common stock of Klein Inc. So it's an equity investment in Klein Inc. for $400,000 in cash, $400,000 credit. Purchased investment in stock, equity method. Dividends received and share of net income. Klein declares and pays a cash dividend of $50,000 on June 30th. So it's cash, $40,000 times 40% is $20,000, and a credit to equity investments Klein Inc. $20,000. You received a cash dividend, equity method. Dividends received and share of net income. Klein reports a net income of $125,000 for 2018. You would debit equity investments in Klein Inc. $50,000, and the revenue from investments. This is your percent of the net income. $125,000 times 40% is $50,000. You recorded revenue earned from investment, the equity method. And here's your T account to show below. Equity investments, Klein Inc. The disposition, Smart Touch Learning sells 10% of the Klein common stock for $40,000 on January 1st, 2019. So they're getting rid of 10% of their common stock for $40,000. So they receive $40,000, and the book value on the date of the disposition, $430,000 times 10%, so it's worth $43,000. So they realized a loss of $3,000. So how do we record that? We would record that as cash of $40,000, a loss on the disposal of the common stock of $3,000, and we would credit equity investments of Klein Inc. of $43,000. So this is disposing of a part of the investment stock with the equity method. Equity securities with control. So if you have control of the company and consolidations, or you own more than 50% of the voting stock, the parent company is the corporation that controls the other company, and the subsidiary company is the company controlled by another corporation. And the parent prepares the consolidating statements using consolidation accounting. Learning objective number 4. Describe and illustrate how debt and equity securities are reported. How are debt and equity securities reported? Corporations' debt and equity securities are reported on the balance sheet in either the current or long-term asset section. And how they are reported depends on the type of investment. Trading debt investments, available for sales debt investments, or held to maturity investments. Trading debt investments are initially recorded at cost, and they are adjusted for changes in fair value. Fair value is the price that would be used if the investments were sold on the open market. An adjustment is recorded as an unrealized holding gain or loss and is reported in the other income and expenses section of the income statement. At disposal, the fair value adjustment is ignored in determining a calculation of the gain or loss. This shows an example of trading debt investments. On December 31st, Smart Touch Learning reports trading debt investments of $26,160. The market value of the trading debt investments is $24,000. The company has an unrealized loss of $2,160 on the investments. $24,000 minus $26,160. So it's a loss of $21,160. So it is a debit to unrealized holding loss trading and a credit to fair value adjustment trading. After the adjustment, the investment T accounts appear as follows. In this case, the fair value adjustment account has a credit balance, and it is considered a contra account and is subtracted from the trading debt investments account to determine carrying value. If the account had a debit balance, it is considered an adjunct account and is added to the trading debt investments account to determine carrying value. So the balance sheet and income statement are as they appear as follows. Available for sale debt investments are recorded at current market value, and they are adjusted for changes in fair value. Disposition of available for sale debt investments is handled in the same manner as trading debt investments. So on December 31st, Smart Touch Learning reports available for sale investments of $60,000, and the market value of the investment is $64,000. So the fair value adjustment available for sale is a debit of $4,000, and the unrealized holding gain is credited for $4,000. Here are the T accounts. They appear as follows. And the report's balance sheet looks like this. Comprehensive income is a company's change in total stockholders' equity from all sources other than owners' investments and dividends, and the comprehensive income includes net income plus some specific gains and losses. As follows: unrealized holding gains or losses on available for sale debt investments, foreign currency translation adjustments, gains or losses from post-retirement benefit plans, and deferred gains or losses from derivatives. Here is an example of a comprehensive learning statement. Held to maturity debt investments are reported at amortized cost, and they may be reported as a current asset or as a long-term asset on the balance sheet depending on the maturity date. Interest revenue is reported on the income statement in the Other Revenues and Expenses section. Equity investments with no significant influence must be adjusted at the end of the year and reported at fair value, and the company makes a year-end adjustment of the equity investment to bring the account to market value. The adjustment is recorded as an unrealized holding gain or loss and is reported in the Other Income and Expenses section of the income statement. And these are debt and equity securities and the accounting methods and financial statement effects. I'll just leave this here. This is all I'm going to go over this week. If you have any questions, comments, concerns, you can email me, call me. I hope that it's been helping, that I have been emailing my comments and corrections to you. I hope that's been helping. I think that it has. So if you guys need anything, let me know. This is week 5, middle of week 5. We're almost done, only another week. I don't know if any of you will be going to, I think one of you at least is going on to Intermediate Accounting 2. I will be teaching that. So anyway, if you guys have any comments or concerns, questions, just let me know. Email me, call me. And I hope you all have a great rest of your week. Thanks.